What's different today than when you started in the business?
The real estate has become a lot more integrated from a capital markets perspective. And by that, I mean the intersection between CMBS and debt and REITs and private equity have all intersected more and more. And what you've seen as a result is in many cases, the big have gotten bigger.
Well, I'd like to welcome everybody to our Buchanan County Capital podcast. And I'm Robert Brunswick, chairman of Buchanan Street. Today, it's my great pleasure to have John Murray as my guest. And just a brief little overview on John, managing director and portfolio manager leading PIMCO's global private commercial real estate team. So quite a significant role in today's economy and role at PIMCO. Prior to joining PIMCO in 2009, he structured real estate transactions with J.E. Roberts throughout the country. So good backdrop. But most impressively, he served prior to that as a combat engineer officer with the U.S. Army. So I am going to want to ask a few questions about that and the training and the contribution to your life here at PIMCO. But also an MBA from Wharton, UPenn, and a master's degree in civil engineering from MIT with a bachelor's degree from Lehigh University. So quite the impressive resume, and you're certainly credentialed, John, and I know we're going to have a fun conversation today. So thank you. And, maybe what I'd like to do with our guest is really start off with a little bit about that background of yours. And, how would you offer that has contributed to your life in the work world? Whether it's your upbringing with your family, whether it's the Army experience, I think that's helpful to have us understand the expertise and strengths and passions that you might have developed that have enabled you to succeed in building your career at PIMCO.
Well, first of all, thank you for having me, Robert. I'm excited to join you on this. I think the takeaway from my background is that I was pretty indecisive early in my career about what I thought I was good at and what I thought I wanted to do. I grew up as a military brat. My father was in the military, so that's pretty much all I knew growing up. So that led to my first role in the Army. From there, between grad school and after grad school, I morphed, if you will, into construction, and then a startup related to the construction industry, and then into real estate private equity. So bounced around a lot. But I would say, the key takeaway of what I learned from all of those different experiences that, a lot of what I think makes a business or a professional successful are consistent. And those are the classic, areas of things like teamwork. In the military, obviously, that's something that I think is first and foremost, but I think applies everywhere. Integrity. And then to dive down a little bit deeper, even just the importance of coming up with a dynamic but active and proactive decision-making process. We're all in a business where we have to make a lot of decisions quickly. So really focusing on having frameworks and processes in place to make those efficiently and consistently as possible, I think is a key that I've learned throughout my career.
Well, first of all, thank you for serving. We appreciate that very much. A great contribution. And I can't help but recall the various people we've had with military background in our life as either customers or employees or just friends. And I see from that a lot of discipline in their protocols. So can you just give us a little insight as we get to know you a bit further before we dive into PIMCO and what you're doing? What does a typical day look like for John Murray? I mean, what is a discipline that you kind of incorporate into your life?
Great question. I'd say the one thing that's nice at PIMCO, we're headquartered in California, but we work East Coast hours. So the military helped me learn how to get up early. But I think that, again, helps in anyone's career. If you can start that day early, ideally get some exercise in, but really knock out what you really need to knock out for yourself early before the rest of the team comes in. I think that really sets you up well to be more responsive and active with your team throughout the day. So I think that discipline really starts with that. It sounds corny, but just getting up early and getting ahead of your day allows you to be proactive versus reactive the rest of the day.
I think that's perfect, and I subscribe to that. So thank you for sharing. PIMCO, headquartered in Newport Beach, founded here I think 1971. We have lots of friends. We've had actually prior PIMCO folk on our podcast. So help our audience really understand a bit about PIMCO, the history of the firm. I think of them, and many might, as a predominant fixed income shop in the glory days, but they're very diversified today. So give us the elevator pitch, if you will, or background on PIMCO.
Sure. Well, you hit the nail on the head. It's 50 years plus in business. PIMCO is one of the largest global asset managers out there, generally known in fixed income, roughly 1.8 trillion of assets under management. But does include over 100 billion of alternatives, so investments outside of the traditional public fixed income side. That includes private credit, distressed credit, specialty finance, and obviously real estate as well. In terms of where we really started to build that side of the business, or when, it was really coming out of the global financial crisis. So starting around 2008 and 2009, PIMCO really saw an opportunity at that point to expand into the private space and really leverage a lot of the relationships we have with banks and capital providers, and our track record and our presence in the public markets. We thought there was a lot of synergies that made a lot of sense to then enter the private space as well. And again, it may seem small relative to the 1.8 trillion, but it's still a pretty substantial platform, even on the alternative side.
Just to make sure I got the math, was that the alts as a part of the 1.8 trillion greater AUM is 100 billion?
Over 100 billion.
Over 100 billion. How much of that is real estate?
Well, real estate, it's if you look at it on a gross asset basis, it's well over 150 billion, including what we have in terms of managed for Alliance, including leverage as well. In CMBS alone, as an example, over 60 billion in CMBS. In private debt, on a sort of gross loan basis, if you will, well over 50 billion there as well.
But that's with leverage. So the equity that's deployed on behalf of your clients is less than that $150 billion number. Got it. Okay. Very helpful. So, and who owns PIMCO today?
So Allianz is our parent company, and that dates back to the late 90s. But in essence, PIMCO is essentially an autonomous investment management platform, again, focused in the areas I just described. We do have some partnerships with Allianz, so we work actively with them in that regard, but that's essentially the parent company.
Great. So when I think about maybe a conventional portfolio construction model, the old day of heavily weighted to fixed income equities with a modest sprinkling of what we'll call is alts. And really today, alts consist of so much more than just maybe real estate. And I think real estate, if I'm not mistaken, is really garnering a big portion in people's portfolio within the alts bucket. But how do you describe alts? And then after you describe it, what's maybe the misunderstanding to the average investor of alts, if you will?
Yeah, alts is a great catch-all for the non-fixed income and non-public securities, equity securities, if you will. I think the simplest way to think about it is anything that isn't public securities. So simplistically, obviously, on the fixed income side, a lot of bonds are traded in public format and then structured into funds, et cetera. And obviously, on the equity side, you've got public securities as well. So alternatives would include really anything private in that regard. So similar loan to a company that isn't a public security would fall under alts, even if that, and really under private credit. Certainly, real estate outside of commercial mortgage-backed securities, which are publicly traded, or REITs, the public equity version of for real estate, the real estate investment trusts. Everything on the private side, what you do for a living, what we focus on a lot on either the equity side of real estate or the debt side, that would fall into the alternatives bucket as well. And as the industry has grown, and I would say continues to grow as a part of, to your point, various investors' portfolios, that those areas get a little murkier, if you will. Structured credit can be quasi-public in some respects, but you're really seeing private credit grow holistically. You're seeing, in many cases, large private lending platforms compete with public securities or public fixed income bonds in terms of what they're providing to their borrowers in that regard. So again, I think the simplest way to look at it is just the non-public or the private version of a lot of the investment strategies out there.
Perfectly said. So, as I think about the profile of your investor, is give me the range of investor, and then does John Murray need to spend any of his day interacting with investors, or are you predominantly focused on making investments?
PIMCO, we truly cover the entire spectrum of investors, from retail or high net worth individual investors that can invest in our mutual fund products, as an example, on one end, all the way to the largest institutional investors out there. And by institutional, I mean investors like pension funds, state pension funds, school endowments, or even sovereign wealth funds in that regard. So we certainly cover the entire spectrum with respect to investors. And in terms of where I spend my time, absolutely. I spend, call it roughly a third of my time working with investors and keeping them updated in our strategies, whether that's on existing strategies or even just our thoughts on what we're seeing in the market. So certainly a big part of my job, and a part that I love.
Let's talk a little bit about your day job and what you really do in terms of making investments and at PIMCO in the real estate space, and what that might entail, the types of different things that you can do within your book at PIMCO.
Well, one of the great things about PIMCO, again, is that we truly cover what I would call the four quadrants. So public and private debt, public and private equity. And again, we've got investment strategies across that spectrum. So where I'm most active today, and where frankly our teams are most active today, would be more on the debt related side of commercial real estate. And we can dive into a lot of the reasons why we see more value there and more activity there. On the public side, in terms of CMBS, that's something, again, that we're always active in. That's an active trading space right now. New issuance in CMBS, i.e. new CMBS loans, have been quite slow for the last couple of years, but that's starting to pick up. But there's always an active trading going on as you know, bonds change in their shapes, if you will. But really on the private debt side, again, is where we've been most active of late. We were Global Debt Firm of the Year last year in commercial real estate. And we really, as well there, lend across the spectrum. So we have strategies to lend on what we call the core part of lending. So a 50% loan to value or less loan on a high quality core like asset, all the way to lending strategies where there are more transitional assets, so lease ups or residential repositionings, all the way into even rescue capital, so buying loans from banks or providing more structured solutions to borrowers. So that's really where in terms of where we're spending most of my time, where I'm spending on the investing side, a lot of my time is opportunities in that area.
And I'm going to assume that each of these areas of activity, these buckets of, if you will, have different yield expectations based upon the collateral and just the risk profile of a particular investment. Is that fair?
Absolutely, and that's something we focus on a lot here. You often hear the comments about what's the right risk-adjusted return. I think that's often a very misunderstood concept. We all like to talk about it, but there's not necessarily a mathematical formula for it in that regard. But the way we look at it in terms of matching risk and return, number one is what does our client want? Is the client looking for safe, reliable income yields? In which case, core lending can make a lot of sense. Or are they looking for more opportunistic, higher return, maybe less cash flow, but more of a J-curve type of return strategies? Again, that would lend more towards equity or even some of the more distressed situations that we're seeing today. So again, it really to us depends on what the client wants. And then as we think about the assets, again, it's really thinking about the steepness of the risk profile and where you sit in the capital structure. Simplistically, from our perspective, a very steep risk profile. So think office today as an example, or even data centers or life science, asset classes that have a lot of tailwinds, but just, there's a fundamentally steeper profile to them. There, we prefer to be on the equity side, where you get the upside in that regard. Contrast that with debt. Again, in debt, you don't necessarily get paid for a steep risk profile. You're really short the options. In the upside, you're going to get paid off early. In the downside, you're going to lose money along with the owner. So again, as we think about where we focus on risk and return, we're always keeping those things in mind.
That was well framed. I think you gave the listenership a nice sense for the range of investment profile and the different risks. We're going to talk a little bit about risk return. And to your point, it's really more of an art than a science when you try and, reconcile a yield to a particular profile of risk. We'll talk about that. But before we do that, you mentioned earlier on about you're leaning into maybe more debt now. Not to say you're agnostic to equity. It has to be the right equity situation. So how would you broadly describe today's real estate investment marketplace? And then maybe with that, you mentioned debt. Where do you see opportunity to put money to work?
Sure. Well, it's absolutely an exciting time in commercial real estate, like it is in a lot of asset classes. Fundamentally speaking, in our view, it's clearly the most commercial real estate is clearly the most dislocated we've seen it since really the global financial crisis. But at the same time, it's different than the global financial crisis. And specifically, we view this as a slower decline, but also it's going to be a slower recovery. And for a couple important reasons. When we look back at the global financial crisis, clearly what drove a lot of that was excess, from a fundamentals perspective, excess supply, particularly in the residential sector, obviously, as well as some hyper-energized capital markets. But that really led to this global recession. Importantly, with respect to commercial real estate, though, what the Fed and the central banks did as a response to the global financial crisis was a huge benefit to commercial real estate in the form of driving rates down. In the US, that was QE, as we all recall, quantitative easing. Essentially, though, what that did was it drove cap rates down in 2010 and 11 as global rates came down. And in many cases, that actually helped banks who kicked the can down the road and pretended extended. It basically saved real estate and allowed for, arguably a V-shaped recovery in commercial real estate as fundamentals slightly improved as well. This time around, it's the opposite. Obviously, real estate wasn't the cause of a lot of the pressures that we're seeing in the global markets today. But unfortunately, it's been the side effect. And in particular, the response by central banks to inflation this time around has been to raise rates. And so obviously, we've all experienced what the after effects of that were for commercial real estate, which is, despite decent fundamentals, cap rates have in tandem moved wider dramatically, thus crushing values, crushing liquidity today. And so then when we look forward in terms of recovery, sometimes I hear people say, now's the time, we're going to have a GFC-like recovery in commercial real estate. I disagree with that because if you look forward, nobody's expecting QE2 in our capital markets in the US. So even if rates are starting to come down, we've seen short-term rates come down a little bit. We're seeing the forward end of the Treasury curve coming down a little bit. But we're still looking at real rates that are 300 basis points higher than they were in 2021. And, at least market expectations today are that rates are going to stay higher for longer. So again, translating that to commercial real estate and the GFC, that suggests a much slower unwind and a much slower recovery in commercial real estate today.
I like the way you said that. I think a reset, if you will, in the minds of a lot of the owners and operators, whether they're looking to sell or whether they're looking to buy, to kind of have the new normal in terms of their right sizing and views of their capital stack.
Exactly. And it's been an emotional roller coaster the last couple of years as we've all watched the Treasury go, generally up, but bounce around. And I think even as recently as a year ago, there's a lot of optimism that rates were going to come down quickly again. And so let's just punt a little bit. Let's extend the loan for 6 months. Let's extend for another year. We're going to be fine. Pretend and extend. It worked during the global financial crisis. But again, if we're all starting to, I think at least as a market, accept the notion that rates are going to be in this new paradigm, to your point, of higher rates. And so kicking the can down the road doesn't necessarily work as well in that type of paradigm.
Which will lead us into some of the opportunities you're seeing. But before we do that, I want to get back to, you clearly have the science side down, John, and I'm sure your team does. So when we talk about the art side and the managing and reconciling of risk return, you kind of started to go down that road, but bring it to life for us as you conceptualize new investments and you make new investments, and that you make sure that you're being paid appropriately for that believed risk. Help us unpack that a little bit.
Sure, absolutely. And again, at first it starts with client expectations. You obviously always have to focus on what does the end client want in terms of of return and where they want, what kind of risk they want you to take. But on top of that, again, as I look at the environment today, simplistically, as a lender, you're short a lot of options, right? So again, in a downturn, as lenders are experiencing today, you can get stuck with the real estate, you can take losses yourself. And in a real upswing, if rates were to tighten dramatically, as an example, or credit spreads, then you're likely going to get paid off early on your loan and not make a lot of profit. So first and foremost, we're always focused on that. And then as that applies to lending, generally speaking, I think about that a lot in terms of what is our option adjusted return. So, adjusting for the fact that in an upside, I'm going to get clipped in terms of my profit. I think that's a key thing that we always focus on at PIMCO. And as it translates down to individual types of assets, again, I'll pick life science as an example. That's a sector that a few years ago was extremely popular, extremely hot. It had all sorts of tailwinds, and certain equity investors did quite well building at the right time in that space. But that's a very unknown sector, relatively speaking. It had a lot of tailwinds due to COVID, et cetera, et cetera. As an equity investor, that can make sense. You can try to capture some of that upside in those huge tailwinds. As a lender, again, you don't get any of that upside. Your best bet is you get your money back. And in the case of life science, you often comes with a very high basis. So in a downturn, you're going to get stuck potentially with a very high basis piece of real estate. And again, you didn't get any of the upside. I'd put data centers in that category. Tremendous upside in that space today. And we see that we're in the equity investments in that strategy. But again, as a lender, you're in a sector that has a lot of uncertainty to it, has had challenges in the past, and in a downturn, a dramatic drop in demand for whatever reason, now you're stuck with a very high basis. So again, I think in terms of how we think about risk return from the debt side, it's always keeping in mind that you're short a lot of options. So generally speaking, volatility, uncertainty, steep profiles, not good for lending. Now, today in this environment, why we like debt is because A, we don't have a lot of competition. B, even in a environment of relatively high rates, if we can lend today at today's values, we feel good about our position. Contrast that with equity today. Again, there are certain sectors where the upside is compelling, but in a world, in my view, where we're going to be in a slow recovery, where values are not going to pick up dramatically from being down, call it 30-40% from 2021. From an IRR perspective, you can find yourself just holding that asset, waiting for a dramatic recovery in rates for a long period of time. And so you're not necessarily capturing all that upside that you would expect to take equity risk.
Well, excellent summary. And I recall from business school days the adage of you can't eat IRR. It's about the multiple. So I assume much of your negotiation or transactions where you can, if it's a whole loan, you're really mindful of that multiple or putting the money to work. And then I would also add that a lot of the return expectation might be correlated to the predictability to liquidity of your exit. That maybe the more predictable your exit, the more you're willing to live with, let's call it a lower overall yield. Are these fair concepts?
Absolutely. And as I think we're seeing today, liquidity is most important, obviously, in downturns. And as we see in real estate, in a downturn, it becomes a lot less liquid than we all might think. So certainly, whether it's an equity strategy or a debt strategy, that's absolutely a very important consideration is, in a downturn, how liquid am I truly? And again, going back to even some of those more esoteric asset classes that are becoming more popular, data centers, life science, et cetera. In my view, the further to the fringe you get in your exposure in a downturn, arguably that's even less liquid than some of your traditional asset classes.
PIMCO, like others, has been quoted in as positioning the regional banks to have continued pressures. And a lot of that in large part is because of their high concentration of, we'll call it troubled or just real estate loans, maybe not troubled, on their portfolio. So talk a little bit about, are we at the early stage? Are we in inning 2? Are we in inning 6? how much more regional bank distress or pressure, and then is that going to provide opportunities for the PIMCOs of the world?
Well, first, just stepping back, again, we all hear about the maturity wave coming and everything else. And to your question, I'd say we're still in the very early innings of that wave of maturities. That's going to put pressure on regional banks. I will add it before I get into regional banks. Importantly, it's also going to put a tremendous amount of pressure on mortgage REITs and debt funds. And we hear a lot about the bank maturities. There's over 200 billion of debt fund and mortgage REIT maturities coming between 24 and 25. And if we think about what a lot of those strategies do, they really have been lending in the just outside the box that banks traditionally used to lend in. After the global financial crisis, thanks to regulation, at least for the big banks got out of riskier development lending and things like that, and kept to a pretty tight box. So to your question on what inning are we in, I think we're still early. And importantly, in that backdrop, whether it's debt funds, mortgage REITs, or even banks, if you think about what most of those loans are, they're typically 3 to 5 year floating rate loans. So importantly, we think back to just 2021, just 3 years ago, that was peak pricing, dramatically low cap rates, obviously a great time for commercial real estate sellers at that time, but a period of arguably high prices, certainly relative to today. Now, why that's important is, again, if you think about that typical loan, say it's a multifamily loan in the Southeast, whether it was a regional bank that lent to it or a debt fund or a mortgage REIT, that typical loan or the asset was probably bought at a 4% cap rate, maybe even less, with some sort of value add light business plan to it. Importantly, it also had a 3-year rate cap on it. So let's fast forward 3 years. Perhaps that asset's performed in accordance with business plan. Perhaps NOI is better. Perhaps the renovation plan worked. But importantly, now we're in a world where that 4 cap asset is a 5.5 cap asset, 6 cap asset. It's down 30+% in value. And importantly as well, now that maturity is hitting, that rate cap is expiring. So why that means we're just now hitting, the wave here is that really there was no distress on that asset for the last 3 years. The asset had a rate cap. It was covering its debt service. The distress is now as the loan matures, and now a new rate cap needs to be bought. Now from a debt service coverage ratio perspective, the asset is, anywhere from 15 to 25% of the original capital structure. So that's the wave that's coming. And again, that's going to hit debt funds. It's hitting mortgage REITs in real time, and it's going to hit the regional banks too. So that's the wave piece of it that again, I think is just now starting to pick up. Now, with respect to banks exposure, first, if we look holistically, banks holistically are less than 20% in terms of their asset base exposed to commercial real estate. But that's really bifurcated between, call it the top 25 banks, the big banks, and then everybody else, which we would call the regional banks. The big banks, the top 25 banks, their real estate exposure is less than 10% of their asset base. Office is generally less than 1%. The big banks aren't going to go down due to commercial real estate. On the regional side, however, the average exposure is over 30%. And more importantly, with extreme dispersion around that 30%. There are regional banks with closer to 50% commercial real estate loan exposure. And then when we dive down even deeper, if you think about your regional bank, by definition, they're regional, oftentimes massive regional concentration in their commercial real estate portfolio, and or relatively large exposure to more troubled asset classes like office, or even if Southeast multifamily as an example. So again, at a holistic level, the number is high, over 30% real estate exposure, but at certain individual levels, much higher. If you look at how regulators look at banks, their bar, if you will, of concern is real estate as a ratio compared to their capital base. 300% being the number where regulators start to get concerned about regional banks. There are a number of regional banks with more like 500% ratio of real estate to capital base. And what that means, without getting too deep into the math, is that if they have a higher exposure to troubled loans and start taking losses, you arguably could see situations where their losses exceed their capital base. And that's, again, where the regulators start to get extremely concerned. Does this mean the banks collapse overnight? No. In fact, as long as the depositors keep their money in the bank, it should be okay. But as regulators start to put pressure on banks, as loans start to become clearly non-performing, as they mature and borrowers don't want to put any more capital in, and the asset becomes REO, those headlines can build up, and you can start to see runs on the bank, like we've seen already with a couple banks in the U.S., and/or call it forced marriages of the FDIC coming in and either taking over the bank or forcing them to sell to another bank. So again, all those pressures are really just starting to build as those peak vintage 21 and 22 loans are maturing. At the same time, again, you've got some regional banks with just massive exposure to commercial real estate.
That was an excellent education and I think just explanation of the asset class and where we're headed here potentially. So getting into the weeds a little bit now. So at PIMCO, with your responsibility, help us now understand with that backdrop that you've just explained, how you go about then working with these banks as what I like to, you coined the phrase or you referenced the phrase, rescue capital. So certainly you're going in there to rescue the bank from maybe an asset so they can survive, so they can gain some liquidity and rebuild balance sheets. But you're also not doing it, in a philanthropic way. You're there as businessmen and you have a fiduciary responsibility to your investors. So help us understand how you then make an investment by buying loans from banks. And then how do you find liquidity at the end of the day with some predictability to that position you bought?
Well, look, first of all, it's in this type of environment, our key is to be a liquidity provider or solutions provider. And that's two basic categories in real estate. It's to lenders, i.e. banks or debt funds, et cetera, or being a solutions provider to the actual borrower themselves. With respect to banks, where we've been most active to date has really been with the bigger banks in buying performing clean loans. Sometimes you hear people say banks are going to sell their worst stuff first. I absolutely disagree with that. That doesn't make a lot of sense to sell an office loan today. You're going to take a massive haircut on it, and you're going to wake the regulators up and potentially depositors, et cetera. But what you're seeing the big banks do, they still have a bloated exposure to commercial real estate. If you look at even the big banks, they haven't had any pay downs the last few years because those 3-year floaters are in the money for the borrower. So they're not refinancing, they're not selling the asset. So even the bigger banks' balance sheets have become bloated with real estate. So their approach is to sell the cleaner loans first, where they take less of a mark-to-market hit. There's still a mark-to-market hit relative to the par balance just because of where spreads and rates have gone. But from a bank's perspective, it allows them to reduce exposure without taking that large of a hit. So where we've been active there is working directly with these banks to identify loans that we think are attractive and generally buying in that 5 to 10% discount to par range. Now, with respect to your question on liquidity for those types of loans, we love those loans because, again, from our perspective, they're very safe, very clean loans. And so we would expect them to pay off at maturity. We just wouldn't expect them to pay off necessarily early because, again, they're good loans for the borrowers. That said, we've seen cases where the borrowers have refinanced or paid us off. So there's the IRR upside, not to your point, not profit upside, but IRR upside to get paid off early in those. Again, I think that's been an area where the banks have been focused to date. I do expect the large banks to start to now sell their soon to default loans. So loans that perhaps are going to have a challenge at maturity, and the banks would rather just get rid of that problem than have that, trouble debt restructuring on their balance sheet or get a higher risk capital charge against those loans. So that's the big banks in terms of what we've been doing in terms of providing solutions and what we've seen them looking to do. Now, with respect to the regionals or even maybe the larger regionals, I think what's interesting there is what we've seen is those banks are looking for more creative solutions. In many cases, they've realized that selling some of their performing loans doesn't necessarily solve the problem, and they have larger issues at hand. So I think the acronym of the day in commercial real estate is SRT, or synthetic risk transfers. This is something that's been done in Europe for a long time, and you're starting to see it really pick up in the U.S. with banks selling generally today private credit non-real estate loans. But the idea is basically the banks are buying insurance and selling a first loss position to other counterparties to get better risk capital treatment for themselves and basically appease the regulators in some respects in terms of their real estate exposure. So I'd say to date, in terms of our activity, it's early days with some of those banks, but we are having an increased level, a number of conversations with banks about more structured transactions than a typical just performing note purchase, if you will.
So really the expected profit on many of these loan buys is really made on the buy within the realization of the exit to realize that profit. So I assume as these things start going down the quality chain, there's just more scrutiny, more underwriting, and more discounting that's needed to justify your placement of your capital in those particular transactions.
Absolutely. With the more challenged loans, whether it's one that's just going to have challenge to refi or one that's clearly looking to be a non-performing loan, certainly those have a much different risk profile to them. And in terms of the risk that you're taking, going back to our comments earlier about risk and return, obviously the way you account for that or adjust for that is just a deeper discount, so that you obviously then get more upside in that regard, and you have more downside protection by coming in at a lower price on the loan.
You mentioned, I'm thinking of this space you're playing in, and that will be a growing area of interest. And $150 billion, I imagine there's a minimum size where you're going to participate or not participate to justify your time and effort in looking at a portfolio. Can you frame that for us?
Sure. I mean, in some ways, it depends again on the strategy and the fund size itself. But typically speaking, we typically look to get involved, whether it's a portfolio of assets or a single asset, north of $100 million in terms of size. So the larger sizes.
Helpful. So we both live in the Newport Beach area. You can't help but understand the impact PIMCO's had to our community. We've been fortunate to have a number of former and current PIMCO employees that are investors of ours. But so we've gotten to know a number of the PIMCO folk in our greater community, and many of them are very philanthropic. But so you've had an opportunity to work under some of the icons of the industry, let alone we're at PIMCO, mavericks, pioneers in the space. So how is that influence and that just culture, if you will, of PIMCO changed, and evolves your career in the way that you kind of approach investing and just approach being a business person in with your day-to-day job?
Sure. I think one of the biggest takeaways I've had at PIMCO, and this is really enforced all the way from the top, is to always be conscious of investment biases, our natural biases that we have. And first and foremost, we need to all recognize that we all have them. And it absolutely applies to real estate as well. And just some examples there, I think that the best one that comes to mind to me is the sunk cost fallacy. That tendency to anchor your go-forward decisions to the past performance of a deal and even the past returns of a deal. Perfect example in terms of IRR is making a decision on a go-forward basis and thinking about what your life of investment IRR is. Your life of investment IRR is irrelevant. It's really, what is my go-forward IRR that matters. And I think that's just something that is paramount to making decisions, particularly in a challenging environment, is forget the past, forget how painful it's been. It's really, what is on my next dollar out, what is my go forward return? And again, it's hard to get away from that sunk cost fallacy. Endowment bias is huge in real estate. You own buildings, you're proud of them, especially if you develop them, you put all this work into them, and it's a natural tendency to expect a much higher price than the reality might be in the market just because it's yours. That's just a classic bias that I think real estate suffers from. The halo effect, which is really, overvaluing something that's just sort of popular for the day. And again, I would caution something like life science, I think got caught up in the halo effect a few years ago. There was lots of great stories and lots of great rationalizations. But if you look at life science today, it's actually facing a severe fundamentals pressure going forward. So again, just always being conscious of those biases that we have, recognizing them, and then trying to force a discipline upon yourself to at least try to step away from that as much as you can. Secondly, would it be what I touched on earlier, which is just always trying to think in an option-adjusted framework. And as we talked about earlier, as a lender, you're short options again. You don't get the upside. Your max return is what you underwrote to maturity. So being conscious and careful in asset classes that are the hot and sexy stories of the day, because again, you don't get the upside, you get the downside of that steep profile in that regard. So just always being conscious of that. And if you think further, especially as a lender, you're also short the non-monetary options of, are you really going to take over that data center? Are you really going to take over that skilled nursing facility? Probably not. So just always thinking about where you sit in the capital structure and what the options are. At PIMCO, we're obviously huge in the fixed income space. I'd say my takeaway in terms of trying to estimate or guesstimate where rates are going, the reality is nobody knows. You can do as much work as you can. We have some of the foremost minds in macroeconomists at PIMCO, but the reality is nobody knows exactly where rates are going. So always stay humble and think about how you can ideally hedge whatever those risks are that you can't control, whether it's rates, whether it's credit. Just always thinking there's certain things you can't control, staying humble and making sure you're hedging those. Last, certainly not least, is diversification. Again, in this market, certain asset classes in terms of their performance can really ebb and flow. We've seen what's happened to office in the last 10 years. We're seeing what's happening to life science today. So just always making sure that you're diversified, and especially if you're a fiduciary for investors, to make sure you're not just going all in on the hottest idea of the day.
Well, I'm quite confident that many listeners are going to replay this piece that we just heard from you because I think it was succinct and very spot on. I mean, I think about the best of the best, the PIMCOs. I mean, there's bets you've made that probably have not worked out in a larger portfolio, despite your top decile performance overall, that you've got to listen to your words and say, we're not going to put good money after bad, or we're going to have to look at the new money as a new investment. So I think the touch point that you first talked about with sunk cost and basis is quite telling. I want to just ask you to expand a little bit. Without specificity of a name, has there been a mentor or mentors for you? One of the things we really try and encourage on our program is for our young people to think about finding mentors throughout their business and life. So are there people that come to mind that have influenced you dramatically there in your PIMCO days?
In my PIMCO days, absolutely. Some of the at least and I won't name names, people I worked with early days, some of whom have retired now. I still think about some of the mantras that they instilled in me, things about, including investment biases and being conscious there, or another one is just always be careful chasing yield. There's oftentimes if it's extremely high yield, there's probably a story to it. So absolutely, again, I think some of the early PIMCO veterans, if you will, have been tremendously helpful in my career.
So we're going to wrap with a few last questions, and you've been very thoughtful and kind with your time. What's different today than when you started in the business? If you look at the market, everybody talks about, it's different this time, and then, but there's always cycles. So what's different today, John?
Well, a couple things. I'll start with the capital markets. In my experience, or at least in the last 10 years even, but certainly over the last 20, real estate has become a lot more integrated from a capital markets perspective. And by that, I mean the intersection between CMBS and debt and REITs and private equity have all intersected more and more. And what you've seen as a result is in many cases, the big have gotten bigger. So platforms like ours, it's paramount that you really cover all sectors of commercial real estate. And I think that's different than even 10, 20 years ago, where you had smaller, more regional or sector focused investment strategies. And in the world of debt, there was a different group of lenders than there were borrowers, and a different group of players in CMBS than there were borrowers or lenders. Today, again, the big platforms like ours do all of that. So it just makes everything a lot more integrated, and in some ways makes the world smaller in terms of decision makers in that regard. And then on the sector side, and I tell this to people entering the industry, I think commercial real estate is in the process over this next 10 years of changing more dramatically than it has in the last 20 years. We're seeing it in office as an example. Office has clearly been turned on its head with remote working at the forefront of that. So to me, that's just dramatically different than what we've experienced in office as rules of thumb, if you will, for the last 20, 30, 40 years. A lot of those rules of thumb today are out the window, whether it's per square foot or what have you, or basic assumptions about lease terms. Similarly, at the same time, as we've talked about, there are new sectors that it used to be extremely niche that are becoming huge sectors, like data centers, which are gigantic in terms of their size and dollars and even demand today. So I think, again, going forward, your typical model portfolios and rules of thumb about what the right allocation is to certain sectors, all that's going out the window. It's a whole new paradigm. A lot of that just tech driven.
That's a great look back and look forward, and I think helpful. And I think about when I got into business a long time ago, 1981, and then we heard about the RTC mess and the access to liquidity, and really liquidity today is much more predictable, which is I think why money has flown to real estate, because it's behaving more like a normal asset class, despite some of the challenges we're seeing in the maybe the outside of the real estate marketplace, just in the greater capital markets.
It's interesting when you look at real estate. A lot of times what's quoted, or what people will quote as to why it's an attractive class is that it's less volatile than other asset classes. The only thing I would caution there is that a lot of times the metric used for measuring volatility in commercial real estate is NECREIF and NECREIF returns, which are inherently driven by appraisals, which are inherently lagged. And my point there is simply that the volatility in commercial real estate values, using that as the metric, is massively understated in that regard. So again, I totally agree. Real estate makes sense in all portfolios. I just always caution that it's arguably a lot more volatile than it might look on paper using NECREIF as your barometer.
It's a great point, and we tell our investors this regularly. These appraisals are looking at backwards information and the lag effect. So we concur that that is something you got to pay attention to, no doubt. So winding down, favorite thing you like about your job, John, on a day-to-day basis?
I love the fact that I'm always learning. Again, obviously the whole industry is changing, so there's learning there. But at PIMCO, just given the global presence and the fact that we touch all parts of finance and capital markets, alternatives, public and private, et cetera, I feel like I'm constantly learning. If I didn't have filters on my email, I could literally just read emails internally all day long and learn. I wouldn't get anything done, but I do love doing it. So it's just a great place to be in terms of just hearing from experts from every asset class, every sector, and getting really interesting, up-to-date insights.
Well, clearly your intellectual curiosity comes to the forefront as you kind of just passionately describe what you do and educate all of us. So we appreciate that. Maybe our last question. You referenced earlier to new people you might you say the next 10 years is going to be more, there's going to be more change or front than the last 25. So with that theme, but other themes, what advice might you give someone, a young person that's looking to start out in our business today or business in general as they think about their own careers?
Sure. Well, just expanding on that, I tell the people entering the industry today, you're as qualified as I am, or a 30-year veteran in real estate, to to try to predict where office demand is going or what the longer term impacts of e-commerce are on malls, because the game is changing so dramatically. that again, all of the rules of thumb that we all used to live by are out the window. So I try to make sure that they understand that be confident and speak up, because again, we're all learning this in real time together as tech is changing everything, even outside of real estate, in that regard. Second, outside of that, I think what I've experienced in my career is the importance of building relationships, and that I tell people it's a much smaller world than you think. And as you progress in your career, that world gets smaller and smaller. So, obviously always thinking about relationships and doing the right thing. You might think, how you treat somebody 20 years ago may not matter, but you never know in 20 years how you might need to work with that person, or you might, be on a deal with them. So I've just always been amazed at how much smaller my world gets. And in that regard, I try to emphasize to people entering the industry is to build relationships with your peers. Ideally, not always just on a deal, just really investing the time to just develop those personal relationships. The deals will come over time as you progress in your career, but really investing a lot of time in that early on will pay off dividends later on in your career in that regard. And then lastly, with respect to your question on career advice, it's a difficult time out there today. But as I am evidenced in my career, truly asking yourself, what am I good at and what I like to do, absolutely applies to real estate. If we think about the extremes, if you're good at and you like project management and building something and managing teams, then that's development or operational related real estate. If you like the math and the cranking out of analyses, et cetera, that's more on real estate finance. So just asking yourself early on, I think, is really important in that regard. And then lastly, in today's environment, is get the reps. It's get in the game. This is one of those periods in commercial real estate where you learn more in the next 3 years than you might have learned in the last 10 years. So just get in the game. Salary, few $1,000s here or there, that's way less relevant than getting to a place where you can get reps and get experience, especially today.
John, I can't thank you enough. I mean, we're going to have you back. The wealth of information and your ability to convey it thoughtfully is really appreciated. I made a number of notes. Get your me time early in the day. This is the most dislocated since the GFC, but slower decline. There's just the concept of SRT, synthetic risk transfer. I've heard it. I'm going to do a little more deeper dive myself on that. But great stuff. And I think, as you said, that the change in the next 10 is more than what's happened in the last 25. I couldn't agree with you more, especially with the advent of all these prop tech applications and their impact to how we use and operate real estate. I think is very insightful. So I want to thank you again. This was a 10. We look forward to having you back for our next program. Thank you very much.
Thank you for joining us on this episode of the Counting Capital Podcast. For informational purposes only and not to be relied on in any manner as legal, business, financial, tax, or investment advice. Nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.